Most high earners are farther away from financial freedom than they actually think because the actual path they're following has them stuck. Look, I get that you're making great money, but one of the problems is that you're still trading time for money. One of the things that is critical is that we can expand that into a revenue generating asset and also building appreciation, and that's what I'm going to uncover for you in this video. So here's what I'm going to show you in this video. Number one, why you are stuck in building your retirement. Number two, what you're doing right now is actually holding you back and not the best place for you to build long-term wealth. And then number three, I'm actually going to uncover exactly what you should be doing with the number one asset class to invest into. I've used this exact approach that I'm going to unlock for you to build $22 million in wealth in the last decade with literally less than 25% debt. Let that sink in. That is a cash flow generating asset of real estate that is worth $22 million, not single family home because we don't make any money off of the home that we live in. We can talk about that in a whole nother video, but also I've been able to reduce the debt because debt pay down is critical. So when you are ready to retire or hit your financial freedom, you have less stress. All of this without creating a JOB. Who wants another job? Nobody, especially if you're like me and you're a high income earner. So I'm going to teach you how to automate about 95% of this. So why traditional retirement fails, right? It's why a lot of young kids, younger than me are using terms like financial freedom. And I agree with them, even though I'm old and I still use the word retirement. It's because the retirement vehicles that you and I are taught to use, the 401ks, the Roth IRAs, all of that is deferred. We can't touch that until we hit a certain age. And I get that it's 100% tax-free, but if you have $100, let's say you have $100,000 today in your IRA and you're 35 years old, you pull that out, you're going to get taxed on it. Are you going to wait till you're 65 years old to be able to touch that? What if you were to invest that today into an asset that not only can yield you 10 or 15% return in cash flow, but also gave you tremendous tax benefits and appreciated? When we put that into VOO or SPY or whatever it is, some type of conservative ETF, everybody looks at the 72 rule and they are literally looking at a 10% return. Well, stock market sucks right now. It's very volatile. Most of us are probably going to have to see a 15 to 20% swing between now and the end of the year to be able to hit a 10% return this year. So the reality is when you look at these investments, you're looking at probably 7.5, 8%. That's your appreciation as your money starts to build. And sure, we have compound interest, but in real estate, we also have compound interest too. But it's one specific element of real estate, and that is short-term rentals that I'm gonna really, for some of you that aren't in them, I'm gonna turn you on to this. If you're a new investor that's already in, there's some things that you need to unlock and really focus on to make sure that you're taking full advantage of it as we dive deeper into this video. So number two, we're really going to talk about short-term rentals. This is what I mentioned earlier. This is the number one asset class. It's not long-term rentals. It's not mid-term. It's short-term. And I'm going to jump right to the chase as to why. It's because of the tax benefits. There is a thing called the short-term rental loophole. You can Google it right there. Go ahead and Google it. This is no BS. It is the best tax advantages that we have for high income earning individuals. So it's what all we do is we go and we buy, let's just say you're gonna buy a $500,000 single family home. You literally get to reallocate the depreciation schedules on the ceiling, on the carpet, on the appliances, and take them from 27.5 years for everything and move that carpet to 5-year depreciation, move that sealing the drywall or whatever to 10-year depreciation. And what that does is we're accelerating that. So the average property is seeing between 20 to 30%, and that's going to eliminate your W-2 income after you've offset your rental income. So think about that. You make that $500,000 investment into a property, you're appreciating, right? And if you invest into a really good market, not even a really good market, just a good market, you should be looking at 5 to 7% appreciation. So I'm a college dropout, dropped out of UCLA. I'm not real smart. Chris, what is 5% of $500,000? That's $25,000 a year in appreciation. You could look at 30 to 32,000 if you're at 7 or 7.5%. But It starts with the tax advantages. For a lot of us, the one thing I want to make abundantly clear is I do not want you to make investments and let that tax tail wag the investment dog. When that tax tail wags the investment dog, then you can end up with a dog of a property if you're not looking at the number one component, which is cash flow, and then number two, which is appreciation, right? If you can nail these three, cash flow, appreciation, and tax benefits, you're going to have an asset that is going to dramatically outperform the stock market. But here's the problem. Most people don't understand short-term rentals. And I get it, because all we see in the news is the bad stuff. It is literally ruining the economy. It is skyrocketing primary residences and rents. It's not. There's been so many studies out there by so many different research firms, by real estate firms. Short-term rentals are not impacting affordable housing. We may think that it does, and it might in some very small markets, die-hard vacation rental markets, but it's not. What it is doing is it's created an asset class for us as high-income earners to be able to park money, generate cash flow, get tremendous tax benefits, and take advantage of appreciation. And it is less complicated, less time-consuming. I know this may sound totally crazy than doing long-term rentals. So a lot of you have long-terms right now, I'm sure, that are watching this. If you have long-term rentals right now, I want you to do one thing when you stop watching this video. I'm going to give you a piece of homework. I want you to do a return on equity audit. Because if you have long-term rentals and you have a bunch of them, you're probably a successful entrepreneur. You're probably a successful business owner, or you're a successful C-suite or manager of a W-2. You have some smarts. The problem is that appreciation has outgrown your cash flow. So that has made this a bad investment for you. Unless you're one of those people that just wants to, ride the appreciation until you're 75 years old and then hand that property over to your kids. And you know what the first fucking thing they're going to do is? They're going to sell it because they're going to want access to that cash. So here's the return on equity audit, because I want you to maximize every dollar of your return for you to be able to hit your financial freedom. So I want you to take a couple of just key data points. What do you owe on the property? What's its market value? Just go to Zillow.com and then reduce the price by like 5% just to be safe. Add on another 10% for closing costs. So literally if it's $700,000 to sell according to Zillow, just remove 15%. And that should roughly be the number of what it's going to cost you to sell that property after commissions and everything. So now you take that number of what you can sell it for less 15%, what you owe, and that's the cash that you will have available. Let's say that's $200,000. You have $200,000 in equity after all closing costs. And a lot of you are going to say, yeah, you know what? Hey, I want to hold on to that $200,000. I don't want to reinvest it. I like making $800 or $1,000 a month. Are you kidding me? $1,000 a month? That is $12,000 a year. So imagine this. I show up to your house and I've got a duffel bag and there's $200,000 in $100 bills in it. And I plop that right down on the table in front of you. And I say, you have the opportunity to take this duffel bag and I will take your property, and you are not going to make $12,000 a year anymore. But you can go and reinvest that $200,000. You can make more money just putting it into Vanguard 500 VOO. You will make more money. At 10% return, that's $20K a year. But if you invest that and go buy a $750,000 property and save, $50,000 to $75,000 to renovate it and upgrade it a little bit, make it super attractive, and you put that into short-term rentals in a good market, you could be generating between $150,000 to $200,000 in gross revenue. Let's just say 150, right, for easy math. And then you go in and you do a 35% return. So your net income is going to be 35% of that $150,000. Well, what's 30% of $150,000? 10% is 15, 20% is 30, 30% is 45. Add on another 5%, you're looking at $50,000 a year in cash flow. So now you've just taken the equity you have in your property, no out-of-pocket cash, and literally gone in and taken that $12,000 a year and just over 4x'd it into $50,000 a year in cash flow. And also you've leveled up to a higher value property, so that percentage of appreciation is increasing as well. Oh, but there's one more thing. Don't forget about those tax benefits we talked about, because you take that property in the middle of America and just stay away from the beach. You can go buy beach properties, but you're going to get less value in the tax benefits. That $750,000 property, probably the lot value $100,000, so that $650,000. If we go back to 100% accelerated depreciation, which I am supremely confident that's going to happen this year, then you are looking at roughly about 30% of the dwelling value, which is going to round that down to $500,000 or $600,000. That's $180,000 in accelerated depreciation. Now, if you fall into the 30% tax bracket, you get to take 30% of that $180,000 of accelerated depreciation to offset that rental income. That's 60 grand. 60 grand in tax benefits, 50 grand in cash flow. Let's say that's appreciating at 5%. You're looking at another $30,000. You're building wealth at well over 100 grand annually on that property. That's how high income earners start to build wealth through the number one asset class available to any human being in America right now, short-term rentals. There is no question I know what you're thinking right now. Bill, that all sounds great, but ain't nobody got time for that shit. Well, you know what? You do, because you can automate 95% of this. And that's what I'm going to show you in this next video of how I run a $22 million portfolio with no VAs, a little bit of assistance from my wife, and literally 2 to 3 hours a week. So check it out now, and don't forget to smash that subscribe button.